Here's the thing. Peter Lynch makes a striking point when he says that investors often spend more time researching refrigerators than they do stocks. This speaks volume about the current state of the market, especially in 2024, when valuations are through the roof. In fact, many investors get excited when stock prices are rising and assume that momentum equals value. But Lynch is warning us against this exact mindset. Think of it this way. Just because a stock is going up doesn't mean it's a good investment. If you're investing without looking deeper into a company's balance sheet or cash position versus debt, you're essentially missing the point. Lynch emphasizes that the stock going up is not a reason to buy it. In other words, hype isn't a substitute for research. And this advice is important for 2024, when inflated prices might cause investors to make poor decisions. But what do you need to know about recessions and market cycles that most investors tend to ignore? Now, let me make this clear. Peter Lynch has been through more than a dozen recessions, and as he points out, the 2024 recession is the most predicted one ever. But here's the crazy part. No one knows how or when it will actually unfold. The truth is, even Lynch himself can't predict the exact time of the crash. See, recessions and recoveries are a part of the natural ebb and flow of the market. I think we can all agree that many investors often get swept up in the anxiety of waiting for the moment when the stock market nosedives, so now we can buy the dip. And this is especially true in 2024, when the stock market might feel like it's walking on a tightrope. But the reality is that you cannot afford to waste time predicting when the bubble will burst. Instead, you need to stick to your long-term strategy. In other words, panicking and trying to time the market is often more damaging than riding out the storm. So, is it possible to spot a company on the verge of turnaround before the rest of the market catches on? The thing is, Peter Lynch doesn't just invest in growth stocks. He looks for companies that are turning around. Think of it this way. When a company moves from crappy to semi-crappy, its stock could double or even triple. It sounds simple, but it's quite huge. Now, in an overvalued market like 2024, while everyone else is piling into already inflated tech stocks or high flyers, Lynch is looking for the underdogs. The companies that have been beaten down but are starting to show signs of bouncing back. And more importantly, Lynch knows when to exit. He makes it clear that when a business becomes terrific and the stock is sky high, that's often the time to get out. In other words, Lynch doesn't fall in love with stocks. He's constantly evaluating, which is key in a market that might be on the verge of correction. And timing your exit is just as crucial as timing your entry. Alright, so can you tell the difference between a company that's temporarily down and one that's sinking under the weight of its own debt? Okay, so now you have two companies you want to invest in, and both of them are in a slump. One has cash, no debt. The other has debt, but no cash. Which one are you going to buy? Well, it turns out Peter Lynch says the company with cash and no debt is a safer bet. Let me explain. When the market is overvalued and prices are inflated, you don't want to be stuck holding a stock that's buried in debt with no clear way out. Surprisingly, many investors overlook this basic principle when the market goes airborne. They get lured in by the stories of promised growth without thinking about what will happen when things don't go as expected. And in case you needed even more proof of this, you should know that Lynch's method of focusing on strong balance sheets has helped him weather countless market cycles. And in an overvalued market, companies that are swimming in debt will be the first to sink if there's a correction. But what we're going to talk about next is even more fascinating. Peter Lynch reflects on why he chose to step away from full-time investing, and surprisingly, it wasn't because of burnout or some downfall. It's far from it. Instead, he prioritized spending time with his family, a decision that many investors might overlook. But here's the thing. Lynch's departure from the day-to-day grind didn't mean he abandoned his core principles. Even now, he continues to work with younger analysts, teaching them the ropes. You see, Lynch's success was never about having the most data or being in the right place at the right time. It was about getting out there, paying companies a visit, talking to their management, and understanding their real-world operations, things that just can't be captured in a spreadsheet. In fact, that hands-on approach is even more critical in today's overvalued stock market. Because when the stocks are inflated, it's harder to tell the difference between genuine growth and plain hype. But what makes leadership the single most underrated factor in a company's success or failure? Okay, so let me get this straight. Lynch just told us that what separates great managers from average ones is their ability to solve problems and lead teams well. He emphasizes that management isn't just about being smart or working hard, it's about getting things done through other people. This skill becomes especially valuable in times like 2024 when stock prices are high, and the margin for error is so slender. So if you're investing in a company in this current market, you'd better make sure they have a management team that knows how to adapt and grow, even in difficult conditions. As it turns out, most retail investors fail to account for management quality in their stock picks, which can lead to disaster when the bubble bursts. So next time you're evaluating a stock, find out who's running the show, because in times like these, that makes all the difference. And investor behavior is a huge thing in the game of investing. It could make or break your success. Here's how. Peter Lynch breaks down investor behavior perfectly when he points out how people rush to invest when things are looking good, but shy away when companies are struggling. This is human nature. We're all drawn to success and avoid what looks like it's failing. But what's even more distressing is that this mindset leads to poor investment decisions, especially in an overvalued market. Here's the thing though, Lynch is urging us to look beyond the current market sentiment and find companies that have the potential to turn things around. In other words, don't just follow the crowd, do your homework, and you might see light in a dark place. To put things into perspective, today's overvalued market might seem like a dangerous place to invest. But as Lynch reminds us, it's also full of hidden gems. You just have to be willing to look where others aren't. Because real success comes when you pick bargains that others are too scared to touch. But how do you know when you're getting in too early or far too late? Now let me make this clear. Timing is everything when it comes to growth stocks. I think we can all agree that jumping into a stock when it's already fully valued is a recipe for disappointment. But you might be wondering, how late is too late? Lynch tells us that even if you didn't catch Walmart at its IPO, there was still massive opportunity 10 years later. Surprisingly, this is a lesson many people overlook, especially in a market like 2024, where everything feels like it's already hit its peak. But looking at the bigger picture, Lynch's strategy is about getting in during the early innings. To put things into perspective, think of those ninth inning stocks, companies that have already grown to their full potential. What's more, these are the ones that tend to be overvalued and risky. So if you're in 2024 looking for opportunities, turns out it's not too late for companies that are still growing but haven't fully matured yet. But wait, are you risking everything by investing in something you don't fully understand? Okay, so let me get this straight. If you don't understand what you're investing in, you're setting yourself up for failure. Now, Lynch's advice here is quite simple. When you truly understand a business, you'll figure out whether a downturn presents an opportunity for buying or it's a sign to cut losses. In the current market where valuations are sky high, it's tempting to jump into the hottest stocks without really knowing what's under the hood. But as you'll find out later, those are the very situations that lead to panic selling when things turn sour. Lynch's fundamental principle is stick to what you know. In other words, understanding your investment is the key to staying calm during volatile markets. With those factors in mind, would you consider insider knowledge giving you a major advantage in the market? Now, Lynch makes it clear that first-hand industry knowledge can be an incredible edge. What's more, he's pointing out that industry insiders can often spot trends before Wall Street does. To draw a much clearer picture, think about someone working in the tech industry who might notice shifts in consumer demand or supply chain issues long before it hits the deadlines. And in 2024, with data that's easy to access on the internet, first-hand knowledge still holds lots of value. This kind of insight gives investors the chance to spot mispriced stocks in their own industries, potentially unlocking huge opportunities. Even though the market might seem chaotic, following Lynch's advice can help you stay ahead of the game. It's all about having a strategy that works even when everything around you feels uncertain. Before you go, we've picked out some videos we think will help you navigate the current market and stay on top of the game. They're right here on your screen, so be sure to check them out. Leave a like and subscribe to our channel if you haven't already, and I'll see you in the next one.